Hi, this is Bill Handel, Vice President of Research and Chief Economist at Raddon. This is a Raddon Research Insight. Today we're going to talk a little bit about the economy. Economically, this has been a very interesting year. When you look at the aftermath of the election, you see the strong consumer confidence, you see the burgeoning stock market, you see the strong business optimism. All these suggest good things. And yet the reality might be a little bit different than that. Actually, we take a look at things like real estate values. In many markets, we have surpassed the pre-recession levels. We see auto sales as strong as they've been ever in 2016. And we see very good unemployment data. All good, right? Not necessarily. So what are the positive economic signs? There really are two major factors that we look at. First is demography. Demography matters because the size of the generations is so different. The millennials and the Gen Zs are much, much bigger than their predecessor, the Gen X, and that alone itself will drive economic activity. So that's a real positive for us. The second major positive for us economically is around innovation. The pace of technological change, while disruptive, is also very positive for us. You can always talk about the negatives that happen with the transformation of society from a technology standpoint, but generally speaking, it drives more economic growth, and that's really what we're looking for. So what are the danger signs? Well, we really look at three different things. Number one is the level of debt that we have in the United States, both public as well as private. We have $20 trillion of debt by our federal government, which equates to $60,000 of debt out on our behalf by the federal government per man, woman, and child in the United States. That's big. But we also have significant levels of private debt. And we have levels of debt today that we owe individually that equal our take-home pay. Now, that may be less than we saw during the financial crisis, but it's double what the levels were in the 1950s, 60s, and 70s. So that's a very significant concern. Debt tends to limit the ability of the economy to grow, excessive debt. The second major factor here is the growth of the administrative state, and we've all seen this. This really is impactful for growth because it limits the ability to innovate. And we see this in terms of the business formation rate of the United States being down so dramatically over the last 30 or 40 years. And the third issue is simply the length of this recovery. We are moving into our 9th year of recovery. This is very, very long in the tooth. Paradoxically, however, the length of this recovery it actually is good news in this sense. It has been a very, very slow recovery, and therefore we haven't built up the excesses that we might have expected. And so that could portend good things in terms of the continuation of this expansion. All in all, an interesting time for us in terms of the economy. We'll continue to keep our eye on this topic and keep you abreast of all the things that are occurring. This is Bill Handel, and this has been a Raddon Research Insight. For more Raddon Research Insights, go out to raddon.com. Thank you.